Financial Freedom Show. My name is Rob Berger. This is our Monday evening, 7 p.m. Q&A. And so those that are in the chat, and it'll start showing up on my computer screen momentarily. I'd be grateful if you could just give me a thumbs up, again, that you can hear and see me, or at least hear me. Probably better. I don't know. But something, that would be great. Change that. So I want to start tonight before we get to we're going to do two things before we get to your questions in the chat. The first is we're going to talk about inflation and how it affects the 4% rule, which deals with effectively how much money you can take out each year in retirement without going broke. So that's the first thing. Then I think what I'm going to do is record my first TikTok while I'm doing the YouTube thing. It's relevant to our topic. It's about I bonds. I get all these questions that I can't respond to. Email just takes forever. And so my thinking is that I'll use TikTok for like these 60-second, answers. So if it works, I'm going to record my first one tonight, which will just take 60 seconds, and it's about I bonds. But so far, the chat is not working. Why is that? I mean, it might be working. It's not working on my computer. So before we get to that, and by the way, if you're watching this after it's recorded live, I will have timestamps. It takes a day or two. We're working on maybe speeding that up, but it does take some time. But let me first pop over to YouTube and look at my own stream and see why the chat is not coming through. According to this, I am live. We're going to take a look at it in studio. Actually, we'll do it over here. Here we go. I'm getting there. All right, I see the chat and I see the thumbs up now. For some reason in Restream, it's not coming through, which is okay. I can figure that out, but I don't know why that is. Anyway, I'll just have to use the old-fashioned way, which is just as good. I see all the questions. So, by the way, I'll get to TikTok in a minute. There was something that motivated that decision today. So let's talk about the 4% rule. So as you, I'm sure you know, we've talked about it a lot. The way the 4% rule works, the theory behind it was in the first year of retirement, you take out, if you have $1 million, just to make the numbers nice and round, 4% is 40 grand. So you can take out 40 grand in year one, but then in year two, you throw the 4% away. That no longer applies. And what you do starting in year two until you're dead is you simply adjust whatever you took out the year before by the rate of inflation. So first year was 40 grand in our hypothetical. If, let's say this year ends at 8.5%, I'm sure it won't, but that's what it is year over year so far. You would take 40,000, you'd increase it by 8.5%. And that's what you take out next year. And the theory behind it is on an after inflation basis, you're taking out the same amount of money, right? On an after inflation basis. So the idea is to keep your spending constant throughout retirement. I think as a practical matter, that's just not how life works. I mean, every study I've read and talking to people that are older than I am, and yes, there are some folks like that, they don't spend the same, after inflation amount of money over a 30-year retirement. And in fact, as you age, even as your healthcare may go up, your overall spending just tends to go down because, you're not doing as much in your 90s if you live that long as you did maybe in your 60s when you first retired. That's the idea. Obviously, for any one of us, that could be significantly different, but I think that's, more or less the deal. But still, I think the 4% rule is good from a planning perspective, and so that's the deal. If you were here on the live stream, I think it was Thursday, we actually looked at what would happen to a retirement scenario. We use Personal Capital's retirement planner. You could use anything. And we were going to crank one of the things you can adjust in Personal Capital is your assumptions as it relates to inflation. So we were going to crank it up to 8.5%. We couldn't The highest that personal capital has right now is 7%. Now, I'm sure if inflation stays high, they'll change that, but you couldn't go to 8.5%. It didn't offer that. And when you put it just at 7% and just left it there, going forward, well, all the numbers crashed and you ran out of money in no time. So I thought, well, two things to think about then as it relates to inflation and the 4% rule. The first is this. Let me show you this on the screen. Here we go. This is from the Minneapolis Fed. And what it is basically the CPI-U number, urban, right? CPI, going back to 1913. And here's the rate of inflation is this column to the right. I don't know how well. Let me see if I can make this a little bigger maybe. And this goes all the way back. So the first reading, 1914, was 1.3%. We had some whoppers, early on. Look at those 17% inflation. Of course, World War I was occurring here. So, and a flu pandemic and, a lot of nastiness. And then, of course, we had years of deflation, right? Here's almost minus 11%. Bengen's paper starts in 1926. That's when he starts evaluating retirement scenarios. He looks at a retirement starting in every year from 1926 to 1976. His research has since been updated further. And the worst starting percent was the 4%. That's how he got it. He said, okay, yeah, and this year you could have started at 7%, that year 10, this year 5, 4%, that's the absolute worst. It's in the late 60s, so that's what we'll go with. And, we have the 4% rule. But the thing I want to show you, first of all, the worst time to retire that Bengen found was the late 60s, which initially surprised me. I figured, well, goodness, from 1929 to 1931, those 3 years, the market lost 90%. Well, wow. Wouldn't that be the worst time to retire? I think so. Except that the thing that helped retirees back then, 1929, it was flat, 0% inflation. And then there was deflation. So you're actually taking out less than the year before. And then in 31, you're taking out a lot less, minus 8.9%. And then in 32, you're taking out even less, minus 10.3%. And even in 33, minus 5.2%. So it was the deflation that saved retirees during that time period. Now, it was still a difficult time, obviously, but it wasn't the worst time to retire. The worst time, late 60s. So if we scroll up here, let's see, late 60s, here we go. So, and by the way, the worst time to retire, the year itself doesn't have to be a bad one. If we look at 66 was a bad year for retiring. From an inflation perspective, it was just 3%. So the year you retire itself could be a great year. But if a lot of the years in the first decade or even first 15 years of your retirement are really bad, and what do I mean by that? What's really bad? Well, apart from the Ohio State Buckeyes not winning a national championship during that time, which would be really bad. Lower stock market returns, if you're losing money a lot of those years, but then coupled with high inflation, that's you need the 1-2 punch. That's really bad. So we go back, we had a lot of bad stock market years, 73, 74 were really bad, but look at inflation, 4% in 68, then 5.5, 5.8, and then we get to 73, 6.2, and look what it does here, 11, 9, almost 6, 6.5, 7, 11.3, 13.5, 10.3, 6.1. So we had what? 1, 2, 3, 4, 5, 6, 7, 8. A decade. Brutal, huh? A decade of inflation that ranged from 6% at the low end to 13.5%. That was the crusher. That was the killer. And at least at the moment, that's good news for us. Yeah, 8.5% ain't fun, and we don't know what the future holds. Maybe 10 years from now, if I'm still recording this, we're still doing a live Q&A on Monday nights, I'll be like, remember back then in 2022? And I said, look, how bad can it get? Woo! But, one bad year is not going to crush us. What really made the late 60s a tough time to retire was 10 years of bad inflation. Now, what's interesting is as you move into the early 70s, mid 70s, you're experiencing bad years as well. If you retired, say, in 73, market's down terribly. And 74 is bad too, if I've got my dates correct. But the length of the bad period isn't as long, because once we get into the early 80s, as we all know, interest rates peaked in 82, and that ushered in a bull market, and bonds and stocks did well. I mean, they had bad years too, but by and large did well. So you were okay. So that's the first thing. 8.5% inflation isn't fun, but if we're going to have a year, and we might, that turns out to be even worse in the late 60s. So maybe the 4% rule becomes the 3.9% rule. You're going to need a lot more than 1 year of 8.5% to do it. The second thing, this is just interesting, well, to me. Last year, I did a lot of videos on the 4% rule, including guardrails. And one of the many guardrails you can put up is to say, I'll start at 5% withdrawal rate, and I'll adjust for inflation. However, my adjustment will never be more than 6%. So if inflation is 10%, I'm only going to increase my withdrawals by 6%, right? And at the time I was recording those videos, and there's different ways to do, there's many variations on that theme. But when I was recording them at the time, inflation, the Fed couldn't get it to 2% if their lives depended on it. And I remember thinking 6%, I mean, when's that going to happen? Well, I guess we know now. So if you're following that, and let's say we end the year at 8.5%, and you're doing your adjustments, yeah, you would take a haircut. You would obviously not increase by 8.5%, which, will that affect your day-to-day life? Well, I guess I don't know. I think for a lot of folks it probably wouldn't. Maybe for some, you need every dollar, it would. But if you're doing some sort of dynamic spending approach where you're not simply just adjusting for inflation, but you're putting caps on it. It can be a cap on your adjustment, like I just described. Another approach is to say, I'll do the adjustment, but before I actually take out the money, I'll calculate what percentage of my portfolio that is. And if it's more than 6%, I'll bring it back down to 6%. But of course, remember, the odds of you hitting that guardrail are going to go up when markets are down and inflation is up, right? So I guess what I'm saying is we're kind of living through what a year ago I thought was just sort of an interesting academic exercise. I don't know what to say about that. It is what it is. All right. Okay, I want to do this TikTok real quick, and it is responding to a question. So I got my phone. I've never recorded a TikTok. Yeah. The reason I'm doing this, I've thought about doing this, as I mentioned, I get a lot of questions that I can answer. So with TikToks, apparently, I'm looking at my phone right. I haven't hit record yet. They're either 15 seconds, 60, or 30. I'm going to try to do this in 60, I know, which will amaze you if I actually accomplish that. Frankly, it'll amaze me too. But so I've been debating, because I get an email. I can literally just hit record. I'm not going to be fancy about it. This is not fancy, at least not yet. I don't know. But someone sent me a video from TikTok from basically an insurance salesman, and I really didn't like the way he was trying to sell basically indexed annuities. I thought he was not being forthcoming. Obviously, I'm not going to say who it was or any of the details, but I thought, there's a lot of good information. Actually, I've seen a lot of investing videos on whether it's YouTube, TikTok, I think are great, but there's a lot of nonsense out there too. And so I decided, I don't know, I'm going to put my voice out there. Okay, so let's do it. What angle should I take? It doesn't matter, whatever. I'm just going to look at the stupid camera. Here we go. Can I do this in 60 seconds? All right, this is my first TikTok, and I'm responding to a question about I-bonds. It says, and here's the question. If I understand Treasury Direct correctly, rates change in May and November. Since I bought in April, will my rates be reset every April and October, or will I somehow get synchronized to the May and November cycle after 6 months? The good news is May and November are when they announce the rates, but that's not necessarily when they apply to your bonds. That depends on when you bought them. So if you bought your bond this month in April, yes, you'll get 6 months of 7.12%. And then when the 6 months is up, you'll get 6 months of whatever the rate is announced in May, which is going to be approximately 9.62%. So remember, May and November are when the rates are announced, but when they apply depends on when you bought the bonds. Okay. I did it in under 60 seconds, and I have no idea how to publish it. I'll have to figure that out later. Maybe I published it. I feel so incredibly old right now. There's a check mark. Do I do that? Oh, there it is. I can watch it, which I'm not going to. Post. Do I want to do a hashtag of video description? How about how I bond interest rates reset? I don't know. Hashtag. Yeah, forget the hashtag. All right, we're done. Now what? Post. Post video publicly? Post now. All right, there you go. Enough nonsense. I just posted my first TikTok. All right. By the way, that question I already responded to in an email, but I can't keep doing emails because my arms are going to fall off. All right. Okay. I have no idea what you guys are saying. You're probably like, who is this clown? Is anyone even watching at this point? All right. So remember, if you want me to answer a question, please tag me. I'm back to that because my Restream chat is not working. I don't know why. But I see the first one. It wasn't tagged, but it's a good question from Kokilta. I don't know who it's from. Kokilta, I guess. Rob, how long did it take you from 200,000 investing to 1 million invested, and did it seem like a long time or not? Well, first of all, who says I've got $1 million? I mean, I don't know. That seems very presumptuous. So I will tell you, just generally speaking, and it doesn't matter what number you pick. It's really hard to get to your first 1,000, your first 10,000, your first 100,000. Pick your number, and like we'll just use 100,000. It just seems like it takes forever. Compounding at first is just like watching paint dry. It just, because the vast majority of your money is coming from your hard work and spending less than you make and saving it. It's not coming from compounding interest yet, because you have, one, because you don't have a lot to begin with. At least I didn't, unless you maybe inherit a windfall or something. And two, you haven't had much time. You need time. So the first, pick your number, 100,000, takes forever. The second 100,000 seems to go by pretty quickly. And the 10th 100,000 or 10,000 or whatever increment you want to use just flies by. Eventually, if you think about it in $10,000 increments, eventually you might see your wealth going up or down by that amount in a single day. So compounding, once it gets going, it's like out of control, right? Which is a good thing. The last thing you want to do is get in the way of compound interest. But like from like 200,000 to 1 million, or we could think 20,000 to 100 grand, it still takes a while. And how much, of course, depends on how much you're saving. I generally, as a general rule of thumb, if you're just starting off, I think you need 10 years. 10 years to, of consistently saving, investing, not messing with it, to really see compounding take off. And I talk about that in my book. I'm looking around like I have a copy. I don't. I think there's a copy upstairs. Anyway. Yeah, 10 years. All right, next question. Let's see. Ooh, from Chris. This is a good one. It's like, this question's like, I almost get scared. I don't want to read it. Rob, what are your thoughts on managing investment portfolios for your family members, such as a sibling or parent? Generally speaking, is it something you would recommend? Why or why not? I would not. I certainly wouldn't recommend it. I wouldn't do it. I might help in some way. I might, if my mom, and people have come to me, family members have come to me, and I'll sit down with them with their 401k and talk it through. Roth versus traditional. How do you want to invest it? I'll explain things. We'll look at it together. They might even do their contributions with me sitting next to them, on their laptop or whatever, on the website. I might help them find someone to help manage their money. But I just think there are 1,000 things that could go wrong and you could ruin your relationship. So I personally would not manage. Now, someone else, if I wouldn't manage anyone's money, family or otherwise. I mean, could there be exceptions to that? Sure. And if, like, for example, if a loved one got to a point where maybe because of dementia or something else, they just couldn't handle their finances anymore, and they gave me the authority, obviously before, they'd have to do it before this, or I guess a court could, but I might do it. But again, like if it's a parent, then it's in some level I have to involve brothers and sisters, because they could get suspicious, or what are you doing with mom or dad's money? And if there's any of that, I'd just as soon pay someone, hopefully a small fee, to do it for us. I just think it's just fraught with issues. Okay, Gus, need to allocate a large amount of cash to BND to rebalance my 3-fund portfolio. Should I do it all at once or spread it out over time? Concerned since BND keeps going down. Well, I would do it all at once. The problem, we'll take a look at BND here, see what how it's doing for the year. I know it's ugly. Here it is. Performance was down today. Year to date, 8.55%. Of course, yields are up. Who knows what's going to happen? I would not at all be surprised if it ends the year down less than it is right now. Now, I'm not going to make any investing decisions based on that prediction, right? I mean, because that's just silly. But it wouldn't surprise me for a couple of reasons. I mean, we've seen a high inflation number, but many think we may have hit the peak for now. In part because core inflation, we strip out like certain categories like energy, had moderated a bit last month. But again, I'm not making predictions from an investing perspective. But for me, I would just do it all at once. If you're uncomfortable doing that, and I get it, I get all the issues with bonds. I mean, of course, it's down 855, right? What's VU? S&P 500. It's down almost as much, I guess 1% less, but still a tough year. If you say, Rob, I hear you, I appreciate it, you do it all at once, but I can't do it, then I would just come up with a plan. Every month, every 3 months, this is what I'm going to do, and not look at what's going on in the market. That's what I would do. If someone said to me, you can't do it all right now, you got to DCA it, dollar cost average, over the next year. That's your only choice, Rob. Then yeah, that's what I would do. All right. I'm dying to look at the TikTok to see if I have at least one person who watched that silly video. I'm not going to do it. I mean, I'm focused on you guys. I won't do it. I might. I could peek. No, I won't. Okay. Joshua. Thanks for all you do. You mentioned in a prior video you were adding value to your portfolio. Yeah, I mean, I'm like making additional investments. Okay. How do you feel about, and we've looked at this, AVUS and AVLV, 40% for the first, 20% for the second. Also, I have AVDE, 20%, and AVUV at 20%. I'm pretty sure we've looked at, if not all of these, most of them. These are Avantis funds. And I've promised to do an Avantis video. I've not done a deep dive on Avantis. What little I've seen, I like them. My recollection is their expense ratios are a tad higher, and they have certain strategies, momentum strategies and things that they claim will, maybe outperform, if I'm remembering correctly. That doesn't necessarily thrill me, but here's Avantis US equity ETF, right? It's 15 basis points, so reasonable, it's still reasonably inexpensive. We can look at the portfolio. So it's a large cap blend. It's not an S&P 500. That would be up closer to where that red dot is, which I don't think is technically the S&P 500. As you can see here, it's some Morningstar index. But in any event, this one's a little more value tilted, which I like. And it's got 1,800 holdings. So we could go to the Avantis website and actually look at their strategy for this. Let's do that real quick. AV, let me pull that up. So the thing to look at, so here's the AVUS website. So it invests in a broad set of U.S. companies. Yeah, we got that. Yeah, right here. Design, I don't know how, you probably can't read that, but I'll read it to you. See? It's a service I provide here. Okay. Designed to increase expected returns by overweighting, which is just a fancy way of saying buying more of, securities we believe to be trading at lower valuations and with higher profitability ratios. And I don't know, it doesn't say what ratios. I'm sure if we dug into it, we could figure that out. So the issue with this is you're not taking sort of a down the middle approach. Now it's not a wildly, it's not an approach that's wildly different than the market, right? But it's still not just your basic total market fund. And it doesn't have a lot of history, I don't believe. I think these are all new, like 2019. Let's go to the fact sheet. Is it going to download it? Oh, here we go. Good. Inception. Here we go. Yeah, 2019, September. So there's not a lot of history on these funds. And I do need to dig into them more, but I do like them. So that one, again, I personally wouldn't choose this fund. I would stick with an S&P 500 or a total stock market. But I certainly can't say if a family member came to me and said, I'm going to put my large cap in AVUS. What do you think? Is that a horrible decision? I would say, no, I wouldn't say it's a horrible decision. So the next one is, this is just large cap value. So that's interesting. So you've got 60% of your portfolio in large cap. That's fine. And this one's even more tilted towards value. So if I were going to use one of these funds, I'll tell you how I would do it. I would, with the first fund we looked at, AVUS, I would probably just go with a S&P 500 or maybe total stock market. Depends on the other funds we'll look at in a minute. And then add this as a potential for my value play. Now, I've done a little of that. Remember, I invested in SCHD, Schwab's fund. And these I don't know how similar these funds are. Let's, I don't know how, it's only got 1.66 yield. Let's do this. Let's go to Portfolio Visualizer. Here, I'll show you. So I'm going to the portfolio. We're going to create a portfolio. And all I want to do is compare. Again, there's not much history here, so it's not going to be all that. AVLV, right? Yeah. We're going to do the AVUS fund and then the Schwab fund. I'm just curious. Again, it's only a couple years data. So look at that. AVUS has won. The total return. Eesh, been rough. But this is only for what? Oh, this is only, they only have data going back to January. So this is worthless. All right. But I mean, I think this is a decent fund. Again, 15 basis points. It's not terrible. And then what else did you have? AVDE is just an international equity fund. Don't know much about this one. 23 basis points. Let's look at the portfolio and what I'm interested, first of all. So again, it's a value tilt. All of this seems to be value tilt, which is kind of my historically has been my approach. I think as I've gotten older and gotten to just a different stage in my life, I tend to end up with a portfolio that's more down the middle of the road. But what I wanted to see was region. So it has, the one thing to know about this fund, and you've added one more, and it could be an emerging market, but this basically has no emerging market, which, by the way, I don't think is the end of the world. Maybe this is an emerging market fund. No. So you have no emerging market in that portfolio, or very little. I don't know. Again, I don't think that's the end of the world. I've usually do have emerging market, but some would argue, what, you're not going to have any China? I mean, whatever the issues are, obviously a lot going on. I started to say a lot going on in Russia. That sounds kind of stupid. There's a war going on. But long term, to not have any capital allocated to some of these countries, some would argue, it doesn't really make a lot of sense. But at the same time, though, I don't know that I would say it's the end of the world. And then you have a small cap value. I like these funds. I do need to do a deeper dive on them. I just haven't had time. I'm a TikTok star. What can I tell you? I'm in demand. All right. Joe, how is the 5-year rule for Roth IRAs determined? If you were to open one today ahead of the tax deadline for 2021, would the clock start ticking today or January 1, 2021? So it's a great question, Joe. And I did a video on the 5-year. There's 2 5-year rules. So check that video out. You can search for it. But I did 2. I think you're talking about not, there's one for Roth IRA conversions. I don't think that's the one you're talking about. So if you open up a Roth now, first of all, what year is it for? Because until you file your taxes today, you could actually designate it for last year. But assuming it's for, and is that what you were doing? Yeah. So it would be, but the time always is deemed to have started on January 1 of the year that the contribution is made for. That's my understanding. Now, I'm not a tax professional. And wherever you open your Roth IRA, they can confirm that for you, but that's my understanding. So Conscience wants to know basically what my favorite small cap value or small cap fund is. I've always just gone with Vanguard. We looked at AVUV just a minute ago. I need to do a deeper dive on it. I've just always used Vanguard. I can't say that they're the best per se, but I'm just trying to get general exposure to that asset class, and it's cheap. I think it's a good way to go. Fidelity has good ones, so there's plenty of other options. Okay, Casey and Nora. Book recommendation for those looking to invest in individual stocks and who love this Q&A show. When Warren Buffett and the interpretation of financial statements. Yeah, so I'm starting to look around. I'm actually going to move my library down here at some point, but I would start with this book. I'll pull it up. And I've read it. I've got a couple different editions of this. I don't think this is the newest. No. Here it is. In fact, you can see I actually bought this book last purchased 2015. But I think I've bought a more recent one. But The Warren Buffett Way. I think this book goes through how Warren Buffett thinks about companies, how he values them. It does get into some math and some metrics, but very easy to understand. And so this is what I'd start with. Again, I think there's, let me see if there's got to be a more recent version. Maybe not. Well, anyway, that's Casey and Nora. That would be where I would start. Buffett talks about some old school books by Ben Graham and Fisher. Is it Philip Fisher? Yeah. You've heard of Fisher Investments. I think they've kind of gone off the rails in my view. Well, with fees, that's the issue. Anyway, these books that Warren Buffett often mentions are hard. They're much harder to understand, and I think a lot of them don't really apply as much today. I don't know if Warren Buffett has said that. Maybe, I don't know, but I would go with the Warren Buffett way. Karen, do you have any recommendations for paying for college? I have a small 529, cash, bonds, EE and I, stocks, Roth, and a tax-deferred account. Are there tax advantages for withdrawing from certain funds? Oh, absolutely. So, and this may be true for EE, but for I-bonds, I think I-bonds to pay for college, I know has a benefit. Let me see if I can get this on Treasury Direct. Yeah, here we go. I've never had to do any of this. So I'm not speaking from personal experience, but I read stuff, and I remember coming across this. The education tax exclusion permits qualified taxpayers to exclude from their gross income all or part of the interest paid upon the redemption of eligible savings bonds when the bond owner pays qualified higher education expenses at an eligible institution. So you want to dig into that. There's going to be rules you got to follow. You want to make sure you know what they are. So that's the first thing. Obviously, a 529 is designed for college. But the other one, I'm just seeing if I can use, we'll go to Morningstar. So this is an interesting article on that very topic. We're using a Roth IRA for college. Can you do it? Yes, you got to follow all the rules. But as, I don't know who Karen Wallace is, but she says, it's better suited as a retirement savings vehicle. You pull money out of a Roth to pay for college, you're losing a lifetime of tax-free growth. So that would not be my first choice. But those are two articles that you can, maybe help you puzzle through some of those issues. All right, Marty, how do I rebalance my IRA when my 3 individual stocks have significantly outperformed my stock ETFs? Instead of 60-40, I'm now almost 70-30. Well, yeah, so that's a great question. So initially, I had a similar problem. It wasn't all within an IRA, which would make it easier. But what I started to do was I would take my stocks, and they were all large cap US companies. So they were just part of my US stock allocation. And maybe you're having this problem. What happened was, and this is largely due to Apple, it grew so big relative to my other investments and then I had Berkshire on top of that. And at the time, I didn't have banks at the time, that they started to take over. I had very little in like a Vanguard total US stock market fund, or it was dwindling. I didn't like that. So what I then did was, okay, I'm gonna take the individual stocks out of the equation. I'm gonna rebalance just based on my funds, but I'm gonna set the mix so that when I add the stocks back in, I get to some stock bond allocation that I can live with. And that's basically what I've done. Now, in your case, because you're in an IRA and you can sell, assuming all of those investments are in an IRA, you can sell without tax consequences. So you could just sell some of your individual stocks, right? I mean, you could rebalance however you want and not have to worry about taxes. So I hope that helps. DB Douglas gave me the popcorn emoji. He's ready to watch, and he's got his popcorn. I like it. I'm now just catching up, by the way, to all the thumbs up that you can hear and see me. Okay. Let's see. VJ from Michigan, welcome. Isn't the 4% rule constant? The variable should be how much you need per year in retirement. Based on this, we calculate how much you must have in your account to retire. Well, so the 4% rule would be considered, you have dynamic spending rules and I guess static. The 4% rule would be considered static, but you shouldn't take from that the amount you withdraw every year is the same. It's static on an after inflation basis. On a before inflation basis, it goes up every year. Well, assuming we have inflation, it goes down if we have deflation. But on an after inflation basis, it stays the same. Dynamic can change even on an after inflation basis. So a good example of a dynamic spending rule would be, I'm just going to take out 4%, not in year one and then adjust for inflation. I'm just going to take out 4% every single year until I'm dead. It's a bit morbid. Anyway, and of course, in years where the market's up, you take out more because 4% times a bigger portfolio is more money. Even this English major can figure that out. But when the market goes down, you take out less, right? And if it goes, you think about early to 2000 to 01 to, it was down 3 years in a row, double digits. If you were following that rule, where you were just taking 4% every year, you were taking a huge haircut every year for 3 years in a row, and that could have happened. I don't know what inflation was. What was inflation in the early 2000s? Yeah, it wasn't terrible, but 3.4, 2.8, 1.6. So that would be dynamic. And by the way, if you really want to geek out on this, Google the Yale spending rule, which is how endowments manage this. And they often do a combination. They'll calculate some of the amount they're going to take out to fund research and whatever else they're funding with their endowments on a static, that is an inflation adjusted basis, not unlike the 4% rule. But that'll only maybe account for 70% of what they're going to take out. The other 30% is on a more of a dynamic approach. So they kind of mix the two. Yeah, you could do that in retirement too. It gets more, not that complicated, but you got to do some math. By the way, I was thinking about inflation, 8.5%. You know, if you're in retirement, well, even if you're not, but particularly if you're in retirement, two things to think about. If you've hired an advisor, their fee, particularly if it's a percentage of assets under management, their fee, again, doesn't include the fees of the funds they have you in, just their fee. The first is, it's a real expense, right? So you need to budget for it. It's going to come out of your investment account, and you might not even know. You might not even think about it. But if you've got $1 million and you're withdrawing 40 grand a year in year one, and your advisor is charging you 1%, of that 40 grand, 10 goes to the advisor. Now, again, it didn't come out of your account and go into your checking account, and then you write a $10,000 check and send it to your advisor. The 10 went directly to him or her, and what you can now take is the 30. When Bingen did his rule, he didn't assume a 1% assets under management fee. He assumed zero fees. So if you're paying 1%, even if they've got you in low-cost index funds, that's great. Maybe those fees are low enough you can kind of ignore them. But at 1%, no, that's a budget item. Yeah. The second thing is, from purely an investment management, it's no more difficult to invest $1 million than 10 million than 100 million. I don't care what they say. It ain't any more difficult. Taxes, estate planning, that's more difficult, but you should be paying someone hourly for that kind of advice. But to manage your investments, it's no different. But here's the thing. If you've got whatever, a 70-30 portfolio, 80-20 portfolio, on average, let's say you're going up 9% a year on average, right? Some years you're going to lose money. Some years you're going to make 30%. Let's say it's 9% on average. That means for an asset under managed advisor, they're getting a 9% on average, a 9% raise every single year, right? That's what they're getting. That's what they're giving themselves for no more work. It's not any more complicated just because your portfolio went up by 9%. They're getting a 9% raise, even if inflation's 2%. All right. That should have been a TikTok video. Man, I missed my opportunity. All right. I didn't look. I turned the phone over, but it wasn't on TikTok. All right. It's a great question, VJ. 4% rule. It's funny how if I quiz people, it's confusing. Well, once you understand it, I don't think it is, but I don't think people really appreciate exactly the nuances of the 4% rule. All right, this is from Dave. I use the total return approach for monthly withdrawals, so a percentage from all his funds. I have cash reserves to bridge market downturns. Okay. When do I pull from cash? When portfolio is down 1% or 5%. So that's a great question. And Dave, I'm going to encourage you to go watch. I think I've got 2 videos on the bucket strategy. I might have 3. The first video said, I love the bucket strategy. It makes so much sense, which is really what you're doing. Now you're using basically 2 buckets, but that's what you're doing. A lot of bucket strategies use 3. And after I tried to, I confronted the very question. I'm pointing over here, by the way, because that's where the comment is. You're here. As I started to, see, there I go again. As I started to wrestle with that question, I'm like, I don't, when do I pull from cash? And how long do I keep pulling from this cash account? What if the market's down 3 years in a row? I mean, and how much cash should I keep in there? And I started to realize this doesn't make any sense. And so I 86'd the bucket strategy. So now I'm at the moment not living on our investments. We're living off of my business income, which we kind of lucked into. But if that all went away tomorrow and I'm living off of our investments, I'm probably going to do it on a quarterly basis. I will have like an emergency fund, no different than, before we retired. So I might have 6 months in an emergency fund, but other than that, I'm just going to take money out probably quarterly. I'm just going to rebalance. And that's okay, because remember, if the market's down, remember the thing the bucket strategy in theory is supposed to protect us from is selling when the market's down. But if the market goes down, by market, I mean the stock market, not the bond market. Anyway, you rebalance, you sell bonds to buy the stocks. So just rebalancing keeps you selling high, whatever assets are higher than the other ones, asset classes, and buying the lower ones. You don't need the bucket strategy. I mean, the bucket strategy just, yeah. So Dave, that's my answer. But definitely, I mean, if you want my more detailed thoughts on it, let's watch those bucket strategy. Oh, Rob wants to know, can I see your TikTok responses as I do not use it? Well, okay. I don't even know how to see I don't even know how to use TikTok. Oh, I got inbox. I got 7. Someone started following me. I've got I got nothing so far. I've got no responses. And I don't know how to work this. So there's that. I have 45 followers. Okay, enough of that. Yeah, so yeah, I don't really, Conscience wants to know if I have a favorite small cap value. I just use Vanguard. You know, historically I used Vanguard's small cap value, which I don't remember the ticker. And I have some of it now, I think. Well, VBR would be the ETF. And if you just wanted small cap, well, they have VS. No, that's not right. Oh, yeah. VSMAX. Or the ETF version is, I'll show you what I'm looking at. Looking at this. The ETF is for just small cap, VB. I think those are great. I don't have any reason to go find anything else. Okay, JA wants to know, are you a fan of Better Call Saul? The funny thing is, and apparently the season premiere tonight, I am a fan. And before the show, you might think I was brushing up on the 4% rule. Oh, no. I was watching Better Call Saul, but I'm like a season behind. And I even had to go back and rewatch. Remember, this is a spoiler alert, but it's going back a season and a half, I think. I don't even remember the context, but he's on the bus getting people to write these postcards I think he's to help his, so I don't even know the names of all the characters, but help his girlfriend get some client not to be indicted. I don't know. Or maybe he was already indicted, for them to drop the charges. Anyway, all these postcards from somewhere down in Louisiana, that's where I am right now. I went back and started rewatching from there. So I got some catching up to do. Yeah, I like it. All right. Slow Joe says, Slow Joe Crow, I am down about 10% on my Vanguard B&D. Yeah. In the last 12 months. Will it eventually recover if I keep holding it due to the underlying bond holdings in the fund reaching maturity? That's not how I would think about it, Joe, because the bonds in the fund will never reach maturity. That's not how this kind of bond fund works. So it's an intermediate term bond fund. And so they're going to buy and sell to stay within that intermediate term. So they will sell bonds at a loss. But remember, when they do that and they buy a new bond, they're buying them cheaper. Like for bonds they're buying today, they're getting them for a lot less than if they'd have bought them at the beginning of the year. So over time, the higher yields that they'll get will make up for the losses, but it takes time. And of course, that is, we don't know where interest rates are going to go. So the losses could get worse. If you want a bond fund that basically holds bonds to maturity, you want bullet shares. That's the name of it. That's just the name that they gave it. They being, I can't remember who's behind bullet shares. Oh, Invesco. Yeah, here's the website. So they have, and they don't have government. So they have corporate bonds, corporate high yield, which is junk bonds, emerging market, and munis. And so that's they hold. And if you go, we can dive into the details. You can see they've got 2020 bonds, 21, 22, all the way to 2031. So I don't know why these are still showing. This should be done. I'm not even sure what this is. I'd have to dig into why that fund even exists. But like if you go to 2022, it'll tell you, here we go, right here. The fund has a designated year of maturity of 2022 and will terminate on or about December 15th, 2022. And then you can obviously read the prospectus for all of the details. I'm curious, what's up with the 2020? What's it say? Here we go. December 15th, 2020 was the final day of trading for this fund and is no longer offered for sale. Okay. Shareholders who did not sell their holdings prior to this date will receive, there you go, $21 per share, representing return of capital. So maybe this is just informational why they're keeping this here. But anyway, yeah, if that's the kind of fund you want for your bonds, there you go. So Go wants to know, what tax year do Roth income limits apply to? Based on last year AGI or current year? If contributing in May 2022, do you look at your 2021 return or your upcoming 2022 return? Well, I always preface these tax questions with I'm not a tax professional, but I'm reasonably confident I got this one. But you want to confirm and verify everything. You really want to do that with everything I say, except for the Ohio State Buckeyes. Any comments about them, you can take it to the bank. So if you're contributing in May of 2022 for the tax year 2022, it's your 2022 income. And you might say, well Rob, that doesn't make any sense because while I think I know what my income is going to be, I'm not certain. Well, that's why they give you more time. That's why the deadline for IRA contributions is not December 31, in this case of 2022. That's why they give you some extra time. But if you were to contribute, and I actually made a mistake this year, not with the Roth, but I accidentally over contributed to an HSA. I'm ashamed to admit it. It happened. It's true. I'm an over contributor. And my tax guy said, Rob, you contributed too much, you knucklehead. Here's exactly how much you need to take out. Do it now before we file your taxes. I said, yes, sir. And I took it out. It wasn't much. But yeah, that's why you have extra time. Like with a 401k, you don't, right? You can't, December 31 comes around, you're done for that year. But with an IRA, you get extra time. All right. Moving along. Aaron, B&D is returning year-to-date lower than the S&P 500. I still can't wrap my head around why anyone would be buying bonds as the Fed hikes rates. Well, I mean, that's fair, except then what do you do with your money? I suppose you could say you could put it in a savings account, although it depends how much you have. That can be not that practical. But also, stocks can come down. That's the thing. I get the point, but then why are you in stocks? Now bonds come down, mathematically. We can almost calculate the value. We can a value of a bond, what the value of a bond or bond fund will do if rates go up by 1%. And that's the same isn't true with stocks. But as rates go up, asset values go down. Real estate, Bitcoin, baseball cards, stocks. So, but yeah, I hear you. But if you're my age, or not even that, or you're in retirement, are you going to be 100% stock portfolio? This is where you really need to invest based on a long-term perspective. Don't get hung up on what things are doing this year. I mean, if for you, not investing in bonds is the way you want to go, I'm not saying that's necessarily a bad decision. But don't make that, I'm not going to make that decision because of what interest rates are doing today or this year. I think the next 10, 20 years. Now, if rates are 150% 20 years from now and they've gone steadily up, and then, we have bigger problems than B&D if that happens. Yeah. Ellen from Cedarville, thanks for letting me know. That's great. Tell my cousin I said hello. All right. Dr. Dan, always look forward to the live Q&As and the great content. Thank you. You are more than welcome. I have fun doing it. Josh, are you worried that your REIT fund will take a major hit when this housing market bubble bursts? No. First of all, my REIT doesn't really own homes. Some REITs probably do. I don't know. But like if you look at the Vanguard REIT, which is the one that I historically have owned. Let's see if we can look at the portfolio. Here it is. I'm just at Vanguard's site now. Portfolio. By the way, before we look at this, I should say Interest rates can certainly hurt REITs, although real estate generally, one might argue, benefits from inflation. But I mean, in the short term, inflation can cause havoc, I think, everywhere. So you'll see like they've got industrial REITs is the big, I guess 12 specialized REITs. That could be like radio towers, and I'm not, things like that. Retail. There is some residential. It's 15%. So, and this though, like could be apartment buildings. I don't know. I can't imagine it's single family homes. So it's a fairly diversified, there's office REITs, industrial, hotel and resorts. I mean, it's a fairly diversified portfolio. It'd be interesting. I don't think performance goes, how far back does this fund go? What was the inception date? I didn't look. What's its year to date? Right, it's got to be right here. Current price is what? So it's at 153 right now. It was at 164, so it's definitely down. But it was lower a year ago, significantly lower. So, again, I look at this 10, 20 years out. I think REITs can be a good diversifier. I've actually been looking at like those real estate crowdfunding, like Fundrise, Realty Mogul, Acre Trader. I know some individuals that run these sorts of like Open Door Capital is one. I know Brandon Turner, he was with Bigger Pockets. If you're familiar with Bigger Pockets, a real estate investing website, great site. I knew Josh, the founder. I've known him. I haven't seen him in a couple of years, but I've known him for, I don't know, 10 or 15 years. And I thought, particularly farmland. I like the idea of investing in farmland. I haven't pulled the trigger on it yet. I'd be curious if any of you have, but the taxes can get complicated. I'm not sure I want that complication. Dacian says 15% of their total portfolio is in Apple stock. And if I'm reading it, it's all in taxable accounts, none in retirement accounts. Financial advisor says sell all and put into index funds. Severe ? Thoughts? Do I count Apple in total asset mix or separate? Well, that financial advisor would probably tell me the same thing. And I think it's sensible, the advice the advisor is giving you. Let's ignore taxes for a moment. For just from a risk and asset allocation perspective, having 15% in Apple is a lot, and I'm thinking about it. That's almost exactly what I have. 15% of my Apple 15% of my portfolio roughly is in Apple stock. I'm not going to sell it. I still think it's a good investment. I don't think it's as good of an investment as when I bought it. And it does give me some single company exposure risk, but I can handle it when I look at my total picture. As I said, I separate out the stocks, do my asset allocation without them, but with an eye towards getting to the right total stock bond. But I remove the individual stocks when I'm allocating between small cap, total stock market, international, right? So, and I think I set the fund allocation at 70-30, if I'm remembering correctly. And then when I add all of my stocks back in, it comes to like 80-20 or thereabouts, something like that. But, from a risk perspective, it is riskier. Your advisor's right. I personally wouldn't incur what for me would be a substantial tax bill. Now, when we give appreciated stock to charity, which we did last year, it's always, at least the last few times, it's always been Apple. So, and it probably will continue to be Apple stock for quite some time. I do ask myself, like, if it all went to zero, what would happen? Of course, that's kind of silly, but obviously I wouldn't be happy if my Apple stock, cut in half. But honestly, if it did that, but not because of anything going on with the company, I wouldn't sell. It's like my bank stocks. Wells Fargo was down 5-6% when they announced their earnings. I own Bank of America. I read their or most of their earnings call today. Fascinating. You should read the Bank of America earnings call, even if you don't invest in banks. One of the things they point out is just how much cash consumers have. It's unreal. What they did was, I wonder if I could pull that up quickly. I doubt it. But what they said was, they said, look, we took a look at how much cash folks had in 2019. And we just looked at customers that had between $1,000 and $2,000 in their checking account. And we took an average. And the average was like $1,400. And then we, today, 2022, looked at the same group of clients. This is all anonymous, obviously. The same group of customers. And their average was like $7,000. I forget the numbers now. And I'm probably, let's see. Am I going to pull up the earnings call? It doesn't matter. It was a big number. It was a big difference. There's a lot of cash to be spent. Anyway. Patrick, knowing that the math says lump sum and risk adverse says DCA, what are your thoughts about investing a larger amount this current market? So I've done a video on this, which I encourage you to watch. I've always done lump sum. The studies do favor lump sum, but the reason they do is because in most years the stock market goes up. So you know, knowing that, do we even need to do a study? I mean, how much analysis do we need to put into this? But there are studies out there. I think Vanguard's done some. What I've not seen is lump sum versus dollar cost averaging when inflation is 8.5%, when interest rates are going up, when equity values are still historically high. That I've not seen. And I suspect the results would be different. Now, that doesn't necessarily mean they wouldn't still favor lump sum, but they might not. I don't know. If anyone knows of a study like that, I'd love to read it. I couldn't find one the last time I looked. I think and this was Paul Merriman's point. He and I were discussing this on a phone call, I don't know, a year ago. He said, I don't know if he said he favors dollar cost averaging, but here was his concern. Someone fairly new to investing, maybe they inherit a little bit of money. They lump sum it, the market goes down by 20%, they feel burned, they get out and they never invest again. And he's really concerned about sort of the behavioral finance side of it. And I think it's a real concern. So again, I go back to my comments earlier. If you want a dollar cost average, a lump sum over a reasonably, say a year, you're not going to get any grief from me. I would just highly recommend that you put down your plan in writing and follow it, no matter what's going on in the market. Okay. Ramon wants to know if I can talk about defined maturity ETFs of iShares. Do you have a ticker you can give me? Are these like the Invesco bullet shares? I don't know what these are. These might be the same thing. Mm-hmm. Yeah, these look like the same concept, if I'm understanding. Here, I'll just pull one up. I didn't know iShares had these. So here's an iShare, iBond. These are not, that's a little confusing. These are not iBonds. I think they call it that because it's iShares. It's like I don't know. That's very confusing. But these are December 2027 term corporate ETFs, exposure investment grade corporate bonds that mature between January and December of 27. So the same concept, same idea. So if that's the kind of fund you want, I don't have a preference for bullet shares versus these. I could do a dive on it. We could look at it at some point, but the expense ratio is only 10 basis points. What it does is fairly comparable. What's the yield on this? By the way, look what they've lost. So that's the one thing I will point out. Yeah, they're not selling bonds, right? They're holding them to maturity, but that doesn't mean it can't lose money. It's lost 7.29%. Now, again, if you hold to maturity, you're going to get the yield. But between now and then, it can lose money. But I'm glad you brought that up. I'll have to look into those. I did not know they had them. Jason says, for an international stock ETF index fund, I have VXUS at Vanguard, which is your total international fund, stock fund ETF. Jason says, I have a Schwab 401k. Would you feel comfortable with VXUS in both or find a Schwab equivalent? I would feel comfortable with both. And in fact, unless I had a reason to pick a different fund, I'd prefer to keep it simple for me. So I'd have the same. I like VXUS. I wish I had it in my taxable account. I don't. I have a different Vanguard fund because of tax loss harvesting. But it's still all good. I like VXUS though. So Phil says, why do you have SCHD in your 6-fund portfolio? Okay. Where did you put this asset as well? Thanks for the great videos. Cheers from Arizona. I love Arizona. In normal times, my son and I go to Scottsdale every year for spring training. We've missed the last. Well, we landed in March of 2020. Ready to watch a game, baby. We go for some lunch at that. It's right in the heart of Scottsdale. I forget the name of it, but it's like a breakfast place. It's big. It's on the corner. Long lines. If you've been there, if you've been to the area, you know it. I just can't remember the name of it. And we're sitting there enjoying our breakfast. I guess it was a brunch. I don't know. Getting ready to go to a game, an late afternoon game, and they shut down baseball. And we haven't been back yet. Couldn't go this year. Well, of course, we were going to go, and then the baseball got delayed and blah, blah, blah. Anyway, one of the, in the 6-fund portfolio, I'd almost prefer to call it a 6 asset class portfolio, right? It's sort of total U.S. stocks, REITs, small cap, international, emerging markets, and there could be overlap there. You could get international and emerging markets all in one fund if you wanted to, and then bonds, right? And that was sort of been my portfolio for a very long time. I'm trying to simplify things, so I'll have exposure to all of those asset classes, but not necessarily in separate funds. Why is one better than the other? Well, they're just different approaches. If you separate, say, emerging markets out of your international, so you have maybe a developed international fund and emerging market, you could get both of those in one fund, but then you don't control the relative weightings of each. If you separate them, see, that's the international sign for separate the two funds, then you can control how much you have in each. And again, as I've gotten older, I'm just like, I don't need that control. I'm fine with the VXUS. But in any event, I just put SCHD. I needed to get some larger cap exposure, and I wanted to value tilt. This wasn't all much money relative to my overall portfolio. I wanted to value tilt, and I like the fund, and it's all in Roths and HSAs. And it was easy. One fund. Here we have 2 HSAs, and I guess just 2 Roths. Yeah. So 4 funds. It's all SCHD. It was easy. Here's a question. I wasn't tagged, but I see it. Is a TIPS fund worth it in this inflation environment? Well, some would argue yes, right? Because the principal balance of TIPS will get adjusted by the rate of inflation. So the theory behind a TIPS bond is you have your let's talk about when they're first issued by the government and they're paying 25 basis points, whatever, 1/8, whatever they were. Now they're going to sell for more than 100. So they're going to end up with a negative yield. Is their yield? I already feel like I'm going down a rabbit hole. TIPS yield right now, the Fed has treasury. Here we go. Oh no, that's not what I want. I want the Fed. Where's the Fed? Here we go. Yeah, it's still negative. So what this means is, so it's negative, but it's been inching up. Look, it was all the way down here, -1 plus something. And now it's at 0.04, 0.06, something like that. Well, I guess it's 0.06, tells me right there. So it's flirting with positive territory. But and you might say, well, why would I invest in a bond that's got a negative yield? But the principal balance of the bond will go up based on CPI. And so, yeah, there could definitely. I mean, I think there's always an argument for tips. And it does, because remember, if inflation turns out to be higher than we expect, tips beat out nominal treasuries. If inflation turns out to be lower than the market expects, then treasuries win. You can think of tips as like you're getting a lower yield for the same bond, but you're also getting an insurance policy against high inflation. And you can actually look at the tips treasury spread. What's the difference in yield between a bond of the same maturity, but one's a tip with that extra insurance policy we talked about, and one just regular old treasury yield doesn't have an insurance policy, and it's the same Fred economic data, and you can see the spread is widened as expectations of inflation have gone up. One thing that's interesting though, we have inflation of 8.5% year over year, but the spread's only under 3%. So longer term, the market is not expecting inflation to stay where it is. But I like tips. I think a portfolio roughly split down the middle between tips and treasuries is not a bad portfolio. Not the only way to do it. That was Swinson's approach. David Swinson, who he's passed away, but he ran the Yale Endowment and wrote a book on investing, and that was his sort of model portfolio. I kind of like it. DB, can you speculate why Buffett recommends Vanguard's S&P 500 and not total market? Since the S&P 500 is chosen by a committee, isn't it more managed than it appears? Well, I wouldn't put it that way. I think, obviously this is speculating, but Warren Buffett obviously is a huge believer in America, the future of America, and Americans' business. And, he's, at least now, he lives in the world of large companies. And he probably thinks that trying to get some relatively small exposure into some small and mid-cap companies is just not necessary. Keeping in mind that if we look at VU, and we look at the portfolio, and we go to weights. Oh, not VU, sorry. I meant VTSAX. Total stock market. Come on, Internet. You can do it. So it has small and mid cap. It's not a huge amount. But I think he just says, look, there's no point in fooling around with these small companies. Long term, the larger companies are going to power the growth. If there are winners down here, they'll eventually make it into the S&P 500. I personally prefer the total market. I've done a video on VU versus VTI, and from what I can tell, the returns are pretty much identical or close to it long term. So I just prefer the greater diversity. But Mike wants to know if there's any news on my next book. Well, the news is I've given 2 books a tremendous amount of thought. I haven't made a lot of progress. I told my wife that I needed to get away for a weekend to work on one of them and do nothing for 3 days, but write. I think that's what's going to happen. Jeffrey says, I grew up in Marietta, Ohio, and I dare you to ponder out loud. I personally don't ponder any other way. About how investing in an irrevocable simple trust should be different. Taxable and moderately aggressive allocation. Well, how you're going to invest in a trust will depend on the purpose of the trust. So I don't know how I could ponder that out loud or otherwise. Who are the beneficiaries? What's the purpose of the money? When will it be spent? Yeah, those would be my first questions. I mean, if it's a long-term, I'm trying to think, if you put money in trust, it's going to go to your kids when you die. Although I don't know that you would have done it that way. You could have set it up that way, I suppose, but I'm not sure that would. I'm not an trust and estates lawyer. I hire one, and that's not how they've set it up for us. But yeah, wouldn't it depend on what you're going to use the money for and when? So Faye wants to know my TikTok username. It's probably going to change if you're even allowed to, but it's Boogoni, Boogonie. And I know that's an odd name. It's actually a reference of my last name and a defense to D4 in chess called the Benoni. One thing I don't know, I'm looking at my TikTok channel, and like I see no idea how to figure out if anyone's watched my video. Although now that I look at it, there's a 0 next to it. I don't think that's hurtful. I don't think anyone's watched it. That's okay. We're going to take over TikTok. It just might take 2 more videos. Okay. Peter says, do you still think, I think that's French, farmer and I don't know, factors still work in a world where it seems technology is likely to continue to explode and change the world? How do legacy funds continue to thrive? I don't really see it that way. I mean, technology has clearly changed everything. But what powers what powers our economy? Certainly, there are technology companies that, as we know, FANG stocks, whatever you want to look at, that are huge. But companies that you wouldn't think of as a technology company, but are leveraging huge tech, but they're everyday companies like Deere & Company. That's not a tech. They build tractors, right? Except that they're also building tractors that no one sits in, and that drive themselves, autonomous tractors, and that use satellites and weather data, and are selling subscriptions to the farmers of this tech. So I think. I think the QQQ of the world will have its day, but it'll also have bad years. I think the biggest mistake we can make is to think, technology stocks, pure technology stocks are just, are going to go to the moon and never come back down to earth. It's just not going to happen. Not going to happen. Even my beloved Apple could take a nosedive. I just hope its actual performance is strong. I care more about that than the stock price, at least day to day, month to month. David, I am concerned that Russia is baiting us into a war. I feel it will happen. What happens to our investments then? Well, you can look back at the market through World War I, World War II, Korea, Vietnam. What do we have after that? 9/11, I guess. Did I skip over a war? I mean, there were skirmishes. 9/11. So long term, barring the powers that be do something stupid where life as we know it ceases to function, in which case we probably won't be logging into Personal Capital to see how our stocks are doing. I don't make these comments casually as it relates to what's going on over there. And I'm watching the news every single day, like I'm sure many of you are. But in terms of our investments, this is just where you need to think long term. What did the S&P? Let's look at this. S&P 500 by year. Here we go. I don't think this includes dividends, but it might. So we go, so 42, 37. So look, 39, 40, 41, pretty bad years, but then look at the next four. Vietnam, some good years and some bad years. And arguably probably didn't have a whole lot to do with Vietnam. At least a lot of it. 9/11, bad, but this was more probably the tech bubble bursting. But even if you attribute all of these three pretty bad years to 9/11, which obviously you couldn't for 2000, well, really even most of 2001, but let's even just assume you could. I mean, look what's happened since. Obviously, that left a mark. So, at the end of the day, we as the human race figure out a way to keep living. And that means making and buying milk and bread and cars and bicycles and, that's just what we do. Could all that come to an end? I mean, sure. But at that point, I don't think the stock market's going to be our biggest concern. Yeah. Vinyl says, think how big your Apple would be if you'd bought in 2004. So true. So true. Jacqueline says, how are we doing on time? We got 8 more minutes. Man. I am debating whether to add REITs to my Roth account or not. I am 30 years old. I might want to take advantage of my Roth account more with some REIT investment income. Thoughts? Well, longtime viewers know I'm not really focused on the income. I don't really care how much dividends the REIT pays. What I care about is total return, and it's true in any account, but I care about it from a tax perspective. So a REIT and a Roth or a traditional account, that's where I would place it, one of those two, because I don't want to pay the taxes on it in a taxable account. But I think, I've always allocated about 10% to REITs, and I think it's done reasonably well. You can back test some of this, and I'll show you how. I won't do it. I'll just show you how. So you go to Portfolio Visualizer. Maybe the easiest way is just to go to an asset allocation. Let me go back. It's this first link here, top, where it says Backtest Portfolio. Go to Allocation. You can then here, and I'm not signed in. I have the premium thing, but I'm not signed in. So you can click Portfolio 1 and just go down and do Boglehead 3 Fund. So this is 50% in U.S. market, international market, and bonds, right? And then we can copy this. But let's do, we'll lower the US to 45 and maybe the global to 25. And then we'll add REITs and put 10% in. I'm just kind of just making stuff up. I don't know if this would be the way I'd do it, but of course, for all I know, Portfolio 1 will crush Portfolio 2. So this is from 94. So we're talking roughly 30 years. Yeah, Portfolio 2 outperformed, although, which includes the REIT. Standard deviation, about the same, but a little lower. Again, I wouldn't read too much into this. For one thing, what if we put the international back to 30 and lowered US to 40 in the REIT portfolio? What happens? It still outperforms, huh? Not by much, but $1,000. So that was kind of my thinking. I think it does about the same, but I like the added diversity. Keep in mind, by the way, that this US, like a total US market fund, like if we looked at, let's just look at this one, Vanguard. We're already at the right page, portfolio. It has real estate. It has REITs in here, right? In fact, real estate's right here. It's 3.77%. So when you add an actual REIT fund, all you're doing is adding even more REITs exposure to your portfolio. If you have a total stock market fund, you already have some REIT exposure. So that's my 2 cents. All right. Looks like Steve was trying to ask a question and Jason was telling him to tag me. But the question, I think, is about BSV, which I don't know what that is. Oh, yes, I do. It's the Vanguard short term. So, so a short-term bond fund isn't going to lose as much, right? We can look at its performance this year. It's lost some. I'm going to guess 2 or 3%. Well, 4%. But that's better than B and D, right? Now, this is short term. But longer term, though, this won't do as well long term. And that's just the trade-off. Do you want a little more stability for lower, longer term results? By the way, kind of the same question we ask when we think stocks versus bonds. But we can go to Portfolio Visualizer and go to the portfolio link. And we can put BSV. I don't know how much data they have on this. Let's see. We'll compare it to B and D. Probably not much. Oh, well, no, they got 14 years. So, the B and D, the second one, it's had 3.2% compound annual growth rate versus 2.07. So longer term, it's like so much. It's just like anything in investing. So longer term, this will probably do better, probably, but it'll be a little more volatile. So, I mean, what you do with that information is up to you. That's how I see it. I tend to stick with intermediate term. It's just what I've done. I don't know, it just felt comfortable. So Rodney wants to know, since BRK, Berkshire, is buying back their shares, $2 billion in Q1, would this be a good time to buy at a discount since they've pulled back a bit? Well, I don't know that I would describe it as a discount. They may have pulled back a bit. I have no idea. Let's see here. I'm just going to my Apple stock app, and I want to look at BRKA. I know you're probably, I buy the B shares. Maybe you buy the A shares, but this gives us more data. They've got a fairly low PE, 8.74. I mean, it's certainly a value play. There's no question about it. I didn't know how much have they pulled back. Well, we can look at their 52-week high and low right here. So we'll go to the B shares for that, just to get some numbers that are down to earth. So they're currently trading at 346, down from 362. But 52-week low, they were 266. So that's why I say I'm not sure I would necessarily say it's a discount. But I've bought some more Berkshire in the last. I'm trying to think when I bought it last. This year, I think. But it wasn't so much because I did some deep analysis and said, oh, it's at a discount or whatever. It was, I think it's reasonably priced, and it's a very diversified stock to own. Yeah, so I like it. I'm not like dumping tons of money into it, but it'd be interesting to see what happens when Warren Buffett retires. How the market reacts to that, and how the company performs. Not the operating companies; they'll, I assume, continue on without any issues. But I guess Todd Combs will run the company. That's now, I think, they've more or less said that. Will they start to pay a dividend? How will he invest? What will be fascinating to see is what kind of acquisitions they do when Warren Buffett's gone. But Ryan says, just finished your book. My wife and I are freedom fighters. I enjoy your videos. Well, thank you. I appreciate that. All right, I got time for one more question. Let's see. Patrick, does it make sense to withdraw money from a tax-deferred account, but without causing him to go into the next tax bracket, and reinvest it in a tax-free account? Well, how would you do that? So you take money out of, I guess, a traditional IRA, and then you're going to what? Invest it in a Roth IRA? Because I don't understand how you're going to invest in a tax-free account. I mean, ideally, you would take money you've earned this year and invest it in a tax-free account. By tax-free, I the only thing I think of is Roth. Maybe you mean something else. I just don't know what that would be. And I think so. Maybe you don't have any earned income. Maybe you're retired. And so, would you take money out of a traditional? Let's assume you don't pay a 10% penalty. You pay the tax on it, but it doesn't cause you to go into another tax bracket or trigger other taxes like extra tax on Social Security or increase your Medicare premiums. So it's not just your tax bracket you need to think about. Well, but if you don't have any earned income, you can't put it in a Roth. I mean, and you could just do a Roth conversion. Yeah, in a sense, what you're describing is a Roth conversion, I think, maybe. But you wouldn't actually withdraw it. I mean, you would, but you'd transfer it. But it almost sounds like you're just describing a Roth conversion. And then the question there's two really important questions on a Roth conversion. The first is, what were your taxes that you pay if you do the conversion now versus what taxes will you pay if you don't do a conversion and you take the money out down the road either in retirement because you need it or because you don't need it, but then eventually you hit the RMD age. What will your taxes be? Which one? You want to pick the lower one. Now, of course, as you might guess, figuring out what your taxes will be, say, when you hit RMD age is near into impossible. I mean, you can't estimate your tax bracket, but there's a gazillion things that can change. The tax laws can change. Your marital status can change. You have to make assumptions about your income when you hit RMDs. You may be thinking, well, I'm not going to be working, but lo and behold, you get a big consulting gig and you're making lots of money. You got to make assumptions about what your returns will be in that traditional account between now and RMDs, what inflation will be. That affects the tax brackets, among other things. So it's not easy, but that's the first thing. The second thing is, if you do the Roth conversion, if you can pay the taxes from a taxable account, your checking account, so that if you convert 10 grand, it all goes into your Roth IRA. That's really where you want to be. And if you do that, how long you keep the money in the Roth, the longer you keep it in there, the better, because you're getting this tax-free growth. And you can actually be in a situation where maybe you thought you estimated your taxes at RMD, you did the conversion, but it turned out 20 years later, who knew, you paid a little bit more tax in when you converted than you would have if you'd have taken it out at RMDs. But because you paid the tax from a taxable account, not from the IRA itself, and you kept it there for a long time, you get that benefit. It can actually work out that you paid a little more in taxes when you did the Roth conversion than you would have at RMD, but because you paid the taxes from a taxable account, you got that benefit and it tips the scales in your favor. Now, if you're trying to wrap your head around all of that, I have a paper for you to read. This is a good way to end tonight. And this is what I've been working on a video, like I've been saying this forever. So here it is. You can just Google Better, BETR, Roth conversions. This is a Vanguard paper. Better stands for break-even tax rate. And they go through an analysis. And the paper, let's see. There's kind of three ways to improve the odds that the conversion will make sense. By far, the most important one is the one I just described. Pay conversion taxes from a taxable account. And then they say invest over a long time, all right? Keep it in there a long time, right? But there are other considerations. This is a summary. Where is the actual study? Oh, here it is. It was the first Google result. Here it is. The better approach to Roth conversion. They get into the math, some pretty graphics. I may have shown you guys this in the past. I don't remember. So, but again, Patrick, I'm not sure if I've answered the question you're asking. It sounds to me what you're describing is, after I thought about it, a Roth conversion, but I'm not positive. By the way, the other thing that a conversion can do is perhaps enable a backdoor Roth if you've converted all of your traditional IRA. Now, if it's a large amount of money, you don't want to do that and trigger a bunch of taxes just to do a backdoor Roth. You need to do the analysis. But and actually, that's one issue that's talked about in that paper. All right, gang, it's past my bedtime, 8:35. Well, not really, but yeah. I've learned that after about an hour and a half of this, I'm exhausted. Yeah, I need to call it a night. So, Lord willing and the creek don't rise, I will be back next Monday at 7 p.m. Check out TikTok. I'm going to do something. I don't know what. I'm going to keep doing some TikTok videos, obviously short. And see you next Monday if you can make it. And I'll do some. We'll have some more YouTube videos. Also, if you want the newsletter, subscribe. The link should be below. It goes out every Sunday. I think it's pretty good. I have fun putting it together. Anyway, thanks for hanging out with me. Have a great week. And until next time, remember, best thing money can buy. It's financial freedom.